Hey, this is Sasha, and welcome to another episode on Hungry for Returns, where I answer your trading, investing, or options related questions just to give you some perspective or another person's ideas. So in this episode, what we're going to do is take a look at covered call options, and I'll show you a variation of setting this up. I'm going to show you kind of how they work. We won't get into adjustments, but I'll answer the question of the basics behind covered call options and what you're really trying to do. If you have a question that you want to ask, if you want to share one by voice, feel free to send a message on our website, tradersfly.com, or submit a voice-related question. Now, with that being said, let's take a look here on the question on screen. And basically, this question is coming in from Pete. He asks, could you please help me with my first covered call option? I own 100 shares of Caterpillar, and I want to sell call options on this. The idea here is the buyer will probably let it expire. I'm not too worried about the stock exploding in the future. So I'm wondering what the process is for setting up a trade like this. How do I determine the strike price to sell the option? Is there anything that could cost me a lot of money in doing this or some unexpected consequences? Thanks so much. All right, so let's take a look. I've already set up kind of a basic trade here for you. So if we take a look at Caterpillar, let's say you own 100 shares of this, and if you have 100 shares of Caterpillar, you're basically at 142.70 at the moment of this recording. So looking at Caterpillar right here, okay, and you can see here on the daily, as we go to, let's say, standard candles, you're basically selling off quite a bit. So what's happening here is, well, let's say you got the stock, but you want to make a little premium because you don't think that stock is going to go that much higher. You want to protect a little bit on the downside. That could be a reason why you're selling the covered call. Also, as that stock, if it's moving a little slow, you could sell a little more premium. But when you sell that covered call, if that call gets hit at expiration, your stock could be gone. So that's why you need shares to be able to do this. Now I'll show you a strategy where you don't, but we'll talk about it here in a second. So basically, we start out with 100 shares of stock, okay? And what you're doing is you're selling a call against it. And the reason you would sell a call here is because, well, you're trying to protect a little bit on the downside. Hey, I want to make a little more premium. I want to go ahead and sell that those calls. And you could go at the 36 day, you could go at the 71 days. 30 to 70 days is pretty good. Anywhere between 30 and 90 days is good. If you go too far out, well, the decay is not that much. If you go, let's say 15 days, well, the issue with that is you can't get wide enough. So let's say I go about 70 days, and here there's a lot of strike prices. So if I compare the probability of in the money here, well, let's say I sell a call contract at 160. Well, here in this case, it's saying 16% probability. That means 16% probability it's going to work in the favor if you're a buyer of that call. So that basically means if you're a seller, you're going to be at about 84% chance it'll work out in your favor. But if you go to the 165s, you're at about a 10%, about a 13 delta here, but about an 11% probability that it'll go in the money. Or in other words, you kind of have let's just say about an 89% chance of it being successful. So if I go ahead and sell one of these, let's say I sell a single, analyze this trade, and I actually already have one on there. You can see what happens here with this graph is that basically I collect premium, $114 worth, as long as it stays under that 165. Now, if it goes over, I technically could have unlimited risk right there to the upside. But that's why you have the stock, right? Because what happens is when you're a seller of a call, the buyer of that call can get that stock at the price that you sold it at 165. So that's why you have stock. Now, when you have stock, and you have stock, let's just say on its own, well, you can make unlimited amount of cash, right? A stock can go to the upside for quite a long time. Now, when you sell that call, you cap your, instead of the profit continuing to go up, you cap it at a certain range at that 165. So that way at 165, no matter if the stock is 180, you sell it at 165. If the stock is at 210, you sell it at 165. You may think this is not a good strategy because, well, you could make much more money. But the thing is stocks don't explode to the moon most of the time. So most of the time they go up, they pull back, they consolidate, they move sideways. So that's why people sell these covered call options. So as the stock goes up, if it, let's say out of 10 months out of 12, it doesn't hit it. Well, every month you're collecting, or every let's say 30 to 60 days, maybe every 2 months, you're collecting about $114. Well, 10 months later, it's about $1,000. So that can start to add up fairly quickly. So what you're also doing here is if the stock pulls back, let's say if the stock pulls back to 120, well, you'll still collect that option premium. So you'll make $114 from it. So in this case, if that stock pulls back to 120, you'd be down $2,125. But without it, you'd be down $2,230. So with that little bit of call premium, it allows you to kind of protect that. The issues, of course, is, well, if it goes beyond, let's say it goes to about $200 per share, well, you're still going to be making your $2,376 or $2,397 at expiration. And it doesn't really matter where you fall to make that much. Whereas, let's say you didn't have that call contract and the stock went to 200, well, you probably make about $5,000 to $6,000 on that. So that's really the issue, is that your stock could get called away or you could have made more money. The downside, well, at least you're being kind of protected. Now, let's take a variation of this. I hope I've explained it in depth enough to take a look at the variation. So here we have kind of 100 shares of stock and we have selling one call contract. But basically, to get 100 shares of stock at 142, it's going to be fairly expensive. So instead, what you could do is do a diagonal. So let's say you do kind of the diagonal at that 165. It's kind of that same level. Let's just go buy a diagonal, analyze the trade. I'm going to show you how it looks very similar. Let's just say I go to the, let's say 155, and we'll do the same call there at 165. So let me take a look here and see, okay, on the diagonal. And I might even go even further. You could do 145. I could do 160 if you want. But the concept is the same. Notice your profit picture here is very similar. So you're still, in a way, doing the same kind of concept where you're capping off your top right there. But the acceleration is still the same type of graph. And you're also capping off your downside risk. Now, this one, to put on this trade, to do this trade, you're basically putting in about $631 of margin, okay, or buying power effect. To put on the stock, right, you got to put up about $14,251 because the stock is $142 a share. So, you know, the capital amount required is a lot less when you're dealing with options right here on the diagonal, but the curve and the risk is still very similar. So what you're doing here is I'm going to sell, let's say, the December 2018. So that'll be, let's see, the December over here is 71 days away. And I'm buying the January's 2019, 99 days away at the 145s. So January 19, I'm buying one, the 145 calls. The December 21st, 2018, I'm selling the front month here, 71 days away, at the 165 strike calls as well. And that creates a very similar picture and a very similar curve as pretty much taking a look at the covered call right here. It's very, very similar. So you can take a look. A little bit different with the capital. Of course, you could go ahead and scale a little more capital on the diagonal if you want. But the capital requirement is a lot less to be able to make you know, the trade look very similar or the same type of risk involved. So anyways, I hope this gives you a little insight and perspective on how to really structure these things a little bit differently, and really how to set up the covered call situation. I would recommend, if you're brand new to this, then just go ahead and do the covered call options because it's a lot easier than doing the diagonals. But overall, you know, they do work in the same manner. If you have questions, but be sure to submit them at our website on tradersfly.com, and maybe your question will get featured on here. And that way you can get a more detailed video response to your question rather than just a quick little email or trying to hunt for things there on the web. So thanks for joining me. I hope to see you next time.